Good afternoon and welcome to today's presentation, Market Pricing 101, the Science and Art of Executive Position Market Pricing and its Role in Litigation Support. Please note the information presented by the expert is not used as legal advice and does not indicate a working relationship with the expert. All materials obtained from this presentation are merely for educational purposes and should not be used in a court of law, sans the expert's consent, i.e. a business relationship where she or he is hired for your particular case. In today's webinar, Mr. Jones will discuss types of litigation assistance from a compensation expert, new and emerging litigation areas, factors that shape the world of executive compensation today, actionable steps for the compensation expert witness, market comparators, survey methodologies, position matching, benchmarking, and difficult to price jobs. To give you a little background about our presenter, Bob Jones is an attorney and CPA with 41 years of consulting experience for various large consulting organizations, employer experience, and government service. He has been a frequent instructor in the CEBS program and the Certificate Series for the International Foundation of Employee Benefit Plans, and has served on the Editorial Board of Benefits Quarterly since its inception in 1984. He has also served on the Educational Board for the Journal of Non-Qualified Plans and Executive Compensation. Bob has written articles on various subjects, including the largest U.S. survey of surveillance and change of control for executives in partnership with World at Work. Attendees who require passcode, the word for today is market. During the Q&A session, we ask that you enter this passcode into the Q&A widget for CLE reporting purposes. The Q&A is located to the left of your screen. Please remember that if you're applying for CLE credit, you must log onto the computer as yourself and stay for the full 60 minutes. You are also required to complete the survey at the end of the program. Please note, the CLE credit cannot be given to those watching together on a single computer. Tomorrow morning, we'll be sending out an email with a link to the archived recording of the webinar. The slides can be downloaded from the resource list by clicking the link at the bottom of your screen. We have also attached a PDF entitled Tips from Mr. Jones that is available to download from the resource list as well. Thank you all for attending. And today, Bob, the presentation is now turned over to you.
Thank you, Rochelle. Good afternoon, everybody. Thanks for joining us, and happy Valentine's Day. What Rochelle just mentioned is there's a tips for the webcast that I added last night, which is a supplemental material that's a little too detailed to have you take notes on, so I wanted to lay it out for everyone. It's about 2 pages worth supplement. If anyone has any trouble getting that, please let us know. Welcome again. The topic is Market Pricing 101, and it really is intended to show the increasing role that compensation plays in litigation, both local, regional, national. I have never wanted to be a compensation expert in litigation for more than a small part of my business, about 10%, but because there are people that do that almost full-time. And I would much rather be a client-serving person the way I think most of you are. But long story short, there are very interesting nuances that arise in litigation in the compensation arena, and that's why it's important to go through some of the details. Typically, the litigation arena has maybe 4 types of cases that are most common, but there are some new ones that are arising. The first one is divorce litigation, which is very common. Someone is claiming that the opposing side is paid or should be paid a certain amount, and that involves compensation expertise. Minority shareholder actions are increasingly arising as the growth in partnerships, LLPs, LLCs, professional groups also increases. Then there are termination actions where it involves everything from covenants not to compete, and there was a some great litigation within the last week that was reported on a covenant not to compete. But this comes up a lot of times where what you pay senior executive officers does have a determination on the company's well-being, on the health of the business, and so forth. And then there's everything else, what I call miscellaneous litigation situations. So we see a lot of these, and in the next slide, really some of the new areas, it depends what the Trump administration will end up doing with Dodd-Frank, but there are a number still of golden parachute rules. The new pay ratio disclosure, if it's allowed to stay, will have a media impact for sure. Companies will be compared with other companies in their peer group in their industry as to the pay differential between the CEO's pay and the median employee in a public company situation. But as you all know, regulations have increased. Regulations involving pay litigation have increased. One good example is New York with its rules for executives whose companies receive a certain part of state business, that they can't be paid more than a certain amount if they're involved in a non-for-profit organization. So there are a lot of tentacles of pay practices that are growing around the country and in each of the states. In addition, what we call the ongoing war for talent means that companies are literally battling for the best executive in their industry, in their peer group, in their sphere, and you see a lot of litigation that revolves around that, both coming and going for executives that join companies. We're going to talk a little bit about salary surveys today. We're also going to talk about peer group selection, which affects how you market price an executive's position. But in setting the stage, this environment has never been more complicated than it is today. On slide 12, I've got a schematic, and as a CPA, we know that a picture's worth 1,000 words, but as a lawyer, I know that sometimes a narrative will be 10 pages to describe a picture. So hopefully you'll get both from me in this presentation. But here's a picture that shows the impact of the lawmakers, the regulators, especially the SEC and the FASB, the Financial Accounting Standards Board, which has been changing a lot of the rules relating to compensation in the last couple of years. Financial sector, managing things like dilution, economic conditions have affected companies, and then the stakeholders. After all, most companies are organized on behalf of their shareholders, and the proxy advisory firms are now watching what the compensation amounts are, how they're arrived at, how they're determined, how formulaic they are, how beneficial to the overall shareholders those calculations are. And of course, the labor unions. One of the reasons the pay ratio rule in Dodd-Frank came about was because the labor unions were complaining that the typical CEO in the S&P 500 in their calculations made more than 330 times the median employee in the S&P 500s. And finally, the media has stoked all of this, good and bad. There are a lot of media exposures that have been beneficial, have caused companies to put pressure on their boards and their compensation committees to reduce pay. In the private sector, it's still, there hasn't seen much of the sunshine on the pay practices there. So a lot of what goes on still is under the radar. And in the not-for-profit sector, the third main sector, being public companies, private companies, and not-for-profit as the three main sectors, not-for-profit has sunshine of its own because you can obtain any company's pay structure for the top executives with a 1.5 to 2 year lag on what's called GuideStar, which is an online service that keeps the tax returns, the 990s, for not-for-profits. All right, so turning to the next slide to set the stage, I'd like to say a little bit about the supplement that I gave you. The supplement talks about the goal of this is to share my experience as an attorney and as a CPA. I got my CPA nights after having no accounting in college, so it is even fresher than it would normally be. And I've been fortunate to serve as a longtime executive consultant to boards and senior management. When you are serving a law firm or an attorney, private attorney, or a company as a compensation expert in a market pricing situation, you will often run into several different types of competitors on the other side. One of them is so-called vocational experts, and I've run across those several times in the past few years, and I just had 2 cases end favorably settled for our side, and that's a good thing. So I'm gonna tell a few war stories, not too many, but a few to illustrate a point. Because CPAs work with numbers, sometimes they get involved in the compensation valuation, the market pricing, and sometimes that's dangerous because of the nuances. And hopefully one thing you'll take away from this session is how complex it is to be an expert witness in a compensation matter for a litigation issue. There are also former HR people who are out there hanging a shingle who are serving as compensation consultants. I contend that you really have to be doing this full time to be able to do it well, because there's so many changes, updates, complexities to the business. And finally, search firms. We've all worked with search firms. I have a number of friends who work for them. They're great organizations. They help align good people with good positions. On the other hand, sometimes they overstate compensation. After all, their pay is often based on a percentage of the final salary and benefits and bonus arrived at for a given executive. So again, that can be a danger area if somebody in a litigation situation is relying on a search firm. So I've listed some best practices which I've learned in working in the last, I'd say 25 years anyway, with legal situations, both in my work as a practice leader for a Big Four, and then as the head of U.S. Comp Consulting for one of the largest global HR consulting firms. I had 170 consultants in our group in the latter position. So the first one is follow the guidance of the lead attorneys. This may be axiomatic, but this is, again, the second paragraph of the supplement we sent you. Follow the guidance of the lead attorneys. The second is listen carefully. Sometimes experts want to show what they know very early, and in a compensation matter, it's very valuable to hear all the nuances, all the subtleties of the litigation and the history of the litigation. Then, after you've waited and you've gotten the picture and it's a clear vision, then add what you can add. And I'm really fortunate as an attorney. I often see the strategy of the lawyers that I'm working with, and I can be a part of the team and make suggestions that they will either follow or not follow. But it's another opinion that if you do it right, it can be valued in the process. And then as the quarterback for the Seattle Seahawks says, preparation is separation. As we go through this set of materials, we'll see how important it is to do your homework and to have an expert that has done all the rigorous attention to detail that's important. And most judges will be able to see clear through that. We just came into a situation where the opposing side was taking shots at the other side on sort of a personal level. Most judges don't want to see that. They want to see straight down the middle. How do you call it? What do you see? What does your experience tell you? What is your conclusion based on the facts as presented? So in 2017, the plaintiff's bar is also actively creating new causes of action. For example, in the merger and acquisition area, there are many lawsuits brought currently where almost at least one lawsuit for every merger situation where the merger is being sued because the disclosure for shareholders wasn't full and comprehensive enough. And often that involves compensation and compensation arrangements. So a lot of this is servicing pretty newly in the past couple of years. At the end of the handout, the supplement, I want to talk about this early on because this is a great sort of organization form for what we're going to talk about. But there was a case in 1949, the U.S. Court of Appeals, Sixth Circuit, Mason Manufacturing, which laid out 13 factors that they recommend to look at reasonable compensation. And those factors are pretty good guiding lights for any expert working in this area. The employee's qualifications and training, the nature, extent, and scope of the employee's duties, employee's responsibility for the company's success, the size and complexities of the business, the ratio of compensation to income, the prevailing general economic conditions. And I'm not going to read them all because my effort to get these to you was so that you'd have them. You wouldn't have to take notes on that part, but we will return to some of those themes. So starting out, in any compensation market pricing endeavor, the first thing to do is to figure out what is needed and what will the report look like. And in most cases, if it is a situation that's publicly disclosed, you may end up blending survey data, publicly available surveys, with peer group data. And peer group data, if it's a public company, is usually available online from the proxies. Each proxy report, if you're a calendar year company, is usually presented to the SEC late in March. And it's amazing how many companies have year ends that are calendar years. Not all do, but many do. So you see a lot of this data show up in early April on the SEC websites and the available proxy information. And of course, in the proxy, the company covers what's called the CDNA, the Compensation Discussion and Analysis. CDNA is a rich, fertile area, source of information about how the NEOs, the named executive officers, are paid, the top 5 executives. So going back to surveys, the first thing we want to do is we want to figure out what type of company is this, what is its industry classification, and that's not as easy as it may sound. There was a famous case a couple years ago where the New York Stock Exchange was compared to IBM, GE, other giants. After all, the New York Stock Exchange is only a $100 million organization, and those are organizations of dozens of billions of dollars in revenue. So getting the comparison and the survey place for the proposed market pricing company is very, very important, very critical. The single, as I say in the handout, the single most important factor is the size of the company in terms of revenue. Size matters, and it will show in a lot of cases, the larger the company, the larger the pay package. That's not always true, but most things that's true. And the larger the company, the more, the higher the pay package and the more complicated the pay package will be. Smaller companies often have one type of long-term incentive, whereas billion-dollar companies may have 4 or 5 types of long-term incentive in the form of different types of equity, restricted stock, stock options, and the like. So in selecting the right survey source, you got to be in the right church, the right pew, and the right seat as much as you can. the first question you need to ask yourself, as slide 14 says, is from what market do we hire our employees, and into what market might we be at risk of losing our employees? And in the executive market for any given company, say telecommunications or pharmaceuticals or retail, that would probably be a national market. So you could use national data. You wouldn't have to stay just with geography, although it might be important if this is a New York City employer to use specific geography. So the answers to those questions will help you describe your market position. And then the factors that are very important are revenue size. In my experience, revenue size is probably the most important factor of all, as is industry. They are very, very important in terms of getting right how you want to price a position. And typically in litigation that I've been involved in, it's more pricing one job, one position, or several top positions, and coming to a conclusion based on those. So getting the revenue size at the beginning and staying within the typical rule of thumb for compensation litigation experts is to, in a revenue range, to take all companies within two times the revenue of the subject company, or 1/2 times the revenue of the subject company. So 0.5 to 2.0 is the range that's typically used. And when I teach my advanced HR class, I remind them that, staying within that range is important unless there are mitigating factors. So when you look at surveys, everyone is different. Everyone is a different level of reliability. A lot of this is experience. A lot of times when I am in a litigation matter and I'm the opposing expert is relatively new or hasn't updated his or her methodology, you'll see older surveys or surveys that aren't quite the level of acceptance. As a general rule, the higher the price, the greater the level of acceptance and the greater the thoroughness. That's not always true, but it's often true that the larger surveys from places like Aon Hewitt, Mercer, Willis Towers Watson, and the like are going to be much more valuable in most cases. Occasionally you'll find that some of those surveys have a larger company bias, so you have to be careful there. You could be, or your report could be challenged based on not being thorough enough, looking at enough surveys to have a good blend that's reasonable. But there is a part science, part art to a lot of this. That's going to be one of the themes throughout the day-to-day. Much of this is science, but a lot of it is art. And then while I'm going to stop in a second at the Q&A, I just want to go back and say, when you're looking at surveys, sometimes we'll only see one survey in an opposing expert's report, and usually I want to rely on at least 3 or 4, maybe more. Some of our reports we've even where we're market pricing, say, 1/3 of a company, we might look at 15 to 16 different surveys, and you learn a lot about somebody, the way the thoroughness with which they display their methodology and show the information in their report. What I've also got in the supplement that I handed out is a lot of our expert reports end up being part survey data, which is often expensive. Some of the survey reports can be $5,000 to $10,000 per report, but you can save on that by buying just a single position from some of the survey vendors who are out there. And then we blend that with the peer group information. Peer group information arguably is often even more accurate because in the public sector, these are the most recent reports that were proxy data revealed the year before and are published. so you can get pretty recent information as that goes. And I just had a case where the opposing expert for a 3-year valuation showed up with 6 peer companies, and I had done my homework. I knew there were at least 20 to 28 peer group companies that could be used, and I put in our report the several quotes from other firms that said that the statistically valid number typically revolves around 12 to 15 peers. The analogy I would give you is if you're going to create a stock portfolio, many experts would say if you're going to create your own stock portfolio, not of mutual funds, you achieve a level of diversity with some number of stocks like 12 to 15. That's a pretty good diverse blend. Same thing with peer group selection. You don't want to rely on 3 or 4 because one high one would skew your result. And that's what it turned out a lot of our case revolved around, that their expert had showed up with a very small number of peers when we demonstrated that there were quite a few that were available. Then in peer group selection, the revenue amount is critical, as I said. The industry is key. And many times you have the luxury of organizing it by number of employees. Some higher employee companies in the distribution, manufacturing, or the creation of intellectual capital. Today you can create intellectual capital with 5 to 10 key employees, but if you're going to manufacture, you'll need dozens of employees to help you with manufacturing and distribution. So there can be a difference there too. So to recap that area in a summary, typically in most reports we will blend survey data, the most accurate we can find, with actual peer group data, which is peer companies and their pay practices, how they do that. Okay, now I'm gonna stop because I'm right at the pretty close to the halfway point, and see if there are any questions. We want to do this throughout, and feel free to send them as you think of a question. Don't just wait till the next break. But is there anything I've said that has triggered a question, a comment, a thought? We'd be happy to answer it.
Thanks, Bob. If all the attendees can enter in the passcode for today, also if you have any questions, you can send those over to Bob as well. And please remember that if you're applying for CLE credit, you must attend for the full 16 minutes of this presentation. Our first question is, what is the most common type of lawsuit that you've encountered?
I think today in the comp area, it's sort of a tie between minority shareholder actions and divorce litigation. What I mean by that is a lot of LLCs, wittingly or unwittingly, sometimes don't share enough information with the minority shareholders. And I've seen this both pro and con, where minority was exaggerating the extent to which they were kept out of the decision-making process. But there are also cases where need to know is very important. And so I think those are going to continue, maybe even increase over time. And divorce litigation over comp, probably on pure numbers, you see a lot more of those, but not everything brings in an expert witness, somebody that would be doing a report or an opinion letter as I might. But anyway, probably both those are the most common.
What is the most challenging part of being an expert witness?
That's a great question. I think the most important part is to listen, as it is in most things as a consultant. Listen carefully and fully, and over time achieve the trust of the managing partner that you're working with, the project or the litigation managing partner. I've really enjoyed the friendships that we've fostered over the years, and I'm very proud of my track record. Usually, if you're working well together and you have mutual respect, good things will happen. And In most of the cases that I've been involved in, we've been fortunate to have favorable settlements. I can only think of one out of the last 20 that wasn't, but the facts going in were pretty difficult. But again, this is an area that requires hard work. It requires a report that the judge will, or any judge will recognize, involves a lot of thought and good rigor, good discipline. I hope that answers that.
Next question: what is the most often overlooked part of being an expert witness report?
I think one of the overlooked parts is case law authority. That's why in the reasonable comp area, reasonable comp is an area where a shareholder might be claiming that reasonableness was not followed, either for state law purposes or for just the general tax code, Section 162. But I think that's one thing too many comp experts aren't aware of or don't keep an eye on the litigation results and what the best practices are. But that does require a lot of experience. It's an area fraught with potential pitfalls also.
Thanks, Bob. You can continue with the presentation.
Okay, let's one other option that you can do is you can, and this is only for the largest litigation, sometimes custom surveys. A custom survey is simply put sending out a questionnaire that some number, 20 to 25% of a database might respond to. And this is usually a more expensive option because it requires sending out questions and collating the data, but sometimes the situation really demands that. We ended up doing this, I think, twice in the last 7-8 years, but it's not what I would call mainstream, something that's out there. The most important thing with market pricing, for all the talent that's on the line today, I want to say this more than once, is getting to know the position and the job position description for the subject that you're market pricing. And in most cases, I will insist on interviewing that person to find out what they do. I have had good results in cases where I did that or we did that and somebody on the other side did not, because you learn a great deal from hands-on asking the subject of the market pricing. Let's say it's a CEO of a public company. What are your job responsibilities? And let's take it down. A lot of positions, the CEO is pretty easy because that's where the buck stops. Usually he or she or they are the ones who have ultimate decision-making authority for the company. They report to the board. They're evaluated by the board. Under English common law, a board is set up to actually review the results of a corporation. And because the board can't be involved in the day-to-day, they hire their own delegate, who is the CEO, who takes over the day-to-day operation of any company. That's the way it's supposed to work. But as you go down from the CEO, COO, CFO, a lot of these positions, depending on the size of the company, depending on the talent level of the executive, he, she, or they may have other responsibilities. And it's really interesting. I've come across the past couple of years a lot of CFOs who have been given line responsibility for company products, operational responsibility. By the same token, in some companies, the COO Chief Operating Officer has sprung up as a position the larger they get. In other cases, that's gone away because the CEO has to be very much hands-on today, and usually is. Not that the CEO doesn't need to delegate and shouldn't have great department heads, but sometimes the COO position has almost become extinct in a couple different industries. And all the way down the line, My favorite is the CFO because working for a Big Four and in national tax for a Big Four, I got to meet, was fortunate to meet a lot of different chief financial officer types, director of finance, director of accounting, controller types, and you do see how many different things they're responsible for. And in a job description, the reason for the interview is, most JDs, job descriptions, are may have been written a couple years ago, haven't been updated. The first thing we do is we go to the subject. If it's a friendly subject on our side, we'll say, we'd like you to list your 2017 job responsibilities. And then that person will do that, and then we'll ask their supervisor to review it, and then we'll ask them both to go over it together, just to make sure that there's a reality check on what's done. Because a given responsibility can have a big difference on market pricing, how that individual is required to do the job. And in litigation, it's almost unacceptable not to interview an executive if there are any doubts about what he or she or they do during the day and what their main responsibilities are. On the other hand, you want to be careful that you don't fall into the trap of listening to some of the hyperbole and not understanding exactly what they do. So one of the ways I try to counter that is to ask, what's the thing you do the most during the day, and have them draw a pie chart of what their job responsibilities are. It's not even that they're trying to dissemble or hide what they do, but sometimes people have a different perception of what they're doing for the good of the company. And we're very fond of saying that no company's job descriptions are always current. You can go to any company today, ask the HR person with due respect, and I have tremendous amount of respect for HR, senior HR people. Ask them, are your job descriptions up to date? And they'll all say, well, sort of, not really, no. I've hardly encountered in the last 5 years anybody who said, yes, we're absolutely up to date today. Because as some of the older listeners know, as Rosanna Banadana said on Saturday Night Live, stuff happens. Jobs change. Jobs evolve. Positions acquire new skills, new competencies, and thus new job responsibilities. So there's a lot of new information that needs to be factored in. And it's almost like the roadmap for your market pricing. You need to know exactly what the responsibilities are going forward to get an accurate appraisal on what the position is worth. It's axiomatic that we've got to start with a good foundation, build from the ground up, and that requires getting the job documentation, having the person, if you can, if it's not too adversarial, or if the person's on your side, finding out exactly what they do. That's mission critical, and I can't emphasize that enough. Now let's go to the situation where I've got some data. I've got a couple surveys picked out. I've got maybe some peers. Now I need to sift through the data and decide what is worthwhile, what is not worthwhile. One of the things you want to do is you want to apples to apples, make them all apply as of the same date. Most surveys are a year old when they're published. They're on prior year's data. So you want to do what's called aging them forward. And that means applying an interest rate to the position, salary, and other information, and increasing that so that reflects a year that's passed at the normal historical rate for the company. And another thing, going back to the appraising the job before you start concept, it is very, very important to understand the company and its competitive environment and its history. Many, many companies pay people differently than the marketplace. And learning about what their practices are is very important, and being aware how they do it. Some companies have never had market pricing at all for any of their positions. No outside person like me has ever come in and said, well, this is what your typical a third of your positions would be market priced at, and looking at the disconnects between where they are now. A lot of companies grow like Topsy, and when they hire people by, let's say, search firm a lot, those positions, job compression can result. Job compression is that newer people are paid much higher than people that have been there for a while for roughly the same tasks. That's not the same as other classifications, but that's an important thing to be aware of. If you've been hiring from the marketplace, your pay levels for those people may be skewed much higher than for people who've been doing it for 5, 7 years or longer. All right, so selecting the data is very important, and determining the quality. I will often throw out a survey because I don't like the rigor that it shows or the reputation that it may have for what we're trying to do. So typically, most surveys will tell you the names of the companies that are represented. They'll tell you the numbers of companies. They'll tell you the numbers of positions. So that's another thing you want to do to sift through. Make sure you get the best representation that the situation warrants. And bad data can affect your credibility down the road. So going back to data adjustments, let's say that we've asked John Smith what his job responsibilities are, and he says, well, I'm a CFO 80% of the time, but I've also got chief operating officer responsibility for a product line, or operating responsibility for a product line. That's 20%, and that's growing on my part. And I have budget responsibility for that operating line. Well, one of the things that people like me would do with that is to take a blended rate, to take perhaps 80% of the pay level for the CFO position and add to that 20% of the pay level for the operating responsibility position. But that's not usually the way it ends up being done. A best practice is to consider a premium, because you've got a CFO who's doing more than one job. And in a couple expert witness situations, I've actually been able to represent to the court that an individual is doing several different jobs, so ought to be paid a little bit more. It's not double, it's not a factor of 100%, but it's a factor of maybe 15 to 10% or more, never more than 25% added on to a given job. So that's called a premium. In some cases, if somebody is doing a couple things but isn't doing one of the standard practice job description responsibilities, you might apply a discount. And again, never more than 25%, but could be any number based on your based on my professional judgment. So data adjusting, getting the data aged, potential geographic adjustments. We all know that San Francisco or New York City jobs are higher cost of living than other areas. When I moved to Pennsylvania from Washington, D.C., ironically, Philadelphia was considered a higher cost of living area than Washington, D.C., which surprised me in 1998 when I moved here. But geographic adjustments are often appropriate. And you need to realize whether you're going to try to lead or lag the market. Some companies, Google is a good example. Google just increased everyone's pay because it felt that its pay levels had lagged for a couple of years. So rather than position by position, they just did a blanket update for all their positions. Now that has two elements of significant hair connected to it. One is it's a blunt instrument. It's not determining whether someone has or has not done a good job in that position. So part of what I would do, typically when I'm market pricing a position, I would assume that the person is getting a meets expectations evaluation every year on a performance evaluation, or exceeds expectations. But we would normally not start with the assumption that somebody isn't doing the job, and that's important to mention also. Okay, I just mentioned geographic adjustments. One thing I want to mention in the handout that I gave you is there will be a lot of pressure from counsel to get you to explain your methodology. And what I found is helpful is I go through some of the descriptions, obviously much more condensed, what we've just talked about with the attorneys on my side before I present a report that I've just done. So to give them context, because there's a little bit of a learning curve with this stuff, and most attorneys are very sharp, pick it up very quickly, but you want to be sure you give them enough context so that when they go into a conference with the other side, they're not surprised or embarrassed by a nuance that they didn't know about. So I can't emphasize enough full disclosure up front as to what you're doing, how you do it. We just had a situation where it was really dueling experts, and we did not throw stones. We stuck to our guns that we found a number of peers for a situation. We believe we'd market priced it reasonably. The other side used more smoke and mirrors and broad-based claims, and I think at the end of the day that served them ill and us well. But I wouldn't change the way I work just for a given situation. But the important point is to explain as I would in working with any of you, explain what my rationale is, what my assumptions were going forward. We have a whole section in our report in the beginning that says assumptions made, and that's so that there are no surprises later on. And then when you get your data, remember that it's important as an expert witness to show all sides. And when I teach this subject to HR, I say it's total direct comp. There's a little bit of the vernacular I should introduce, and one is base salary is just that, base salary. It's what you're paid every day, either an hourly or an exempt rate. But then there's called total cash comp, TCC, and total cash comp is base plus bonus, if any. So it's often, and I won't get too far afield into bonuses or annual incentives, but there's often a target bonus involved. But we would typically use what has the company's results been, what has the executive been paid. And then the third level is called TDC, total direct compensation. That's base plus bonus plus benefits plus everything else. Now, why would that be important to consider when people are often shouting about salaries and bonuses and not anything else? We've seen a lot of cases in history, and USA Today just had a list of, within the past couple of weeks, of the retirement benefits that some of the Fortune 500 are going to get or are getting now that they've retired. That is a huge number. That has a huge shock factor with most boards, most public consciousness, and you can pay someone very a low level in the bottom third for base and bonus, but pay them at the 90th percentile for retirement plan and still be be way high in terms of total direct comp. So what I'm emphasizing here is to take the whole thing into account. Take all benefits, all perks. I've had a lot of situations where somebody's getting a limousine service, a new car every year. Those things all add up, and a number of country club memberships. Those things have a price tag too, as does additional health and welfare benefits, other benefits that all add up. So one of the things that's important is to consider everything all in and ask the questions about what are the other elements of the pay package. Don't just take base and bonus and be done with it, because the other things can make a material difference. And finally, in the public arena, the biggest single factor, it's not salary, it's not bonus, is the long-term incentives. The equity amounts often are 40, 50% of the total package of an executive, say, in the S&P 500. And the reason for that is they get awards every year. They've often performed very well based on the pay-for-performance guidelines that are out there. So all of that needs to be considered and factored in and evaluated. And evaluating that is part of what we do in a report for the court, because the typical litigation situation, they want to know, has the person been reasonably paid? Has the person been paid on a pay-for-performance basis that would benefit the shareholders in the corporation, or have there been evidences of excessive pay practices? And one other thing that is an important foundation of all of this, most companies, nearly every company out there, ought to have a compensation philosophy in writing. Now, in the public arena, the exchanges require this, but in the public arena, what do I mean? A written compensation philosophy says XYZ company plans to pay its top executives at the 50th percentile for base and 50th percentile for bonus, and trend toward the 75th percentile with superior performance for long-term incentives, something like that. In other words, being specific as to the category. And my favorite example is I once had a college that paid everyone at the 40th percentile, but had, for one of the member colleges, all employees could send their children to any one of the member colleges tuition-free, and they had a long line waiting to get in. Nobody ever left. Their retirement benefits were pretty low, but because of even though the pay was at the 40th percentile, in other words, below the median, below the 50% above, 50% below, they attracted so many people. They were such a popular employer. And if you had 4 kids, they could all get sent to one of the 28 member schools in their organization that tuition free. So we found that they were actually saving money over time by low turnover. Most colleges, universities have a 10% turnover. This group had a 3% turnover. And they were saving money each year by retaining good people, by not having to hire for new positions, by not having lost somebody good and had an open position for 6 months, all of the above. So your philosophy, what you intend to do in the pay practice area, especially for your execs, is very, very important to lay out from a board standpoint, even for a private company, even for a not-for-profit. State where you want to be and then strive to go there. Because as Lewis Carroll wrote in Alice in Wonderland, any road will take you there if you don't know where you're going. So specificity is important. Laying out what the goals are for the compensation package is important. And where we come into a situation where it hasn't been done, we won't make a judgment. We will just say, well, right now it's at the 50th percentile for base salary. It's at the 75th percentile for bonus. A couple situations I've had are in the 90s. 90th percentile, and then you can say, well, it's really pretty high compared to their performance. But another caution is if you're doing your comp philosophy and you say, well, we want to pay our people in the top quartile. Well, that's fine, but do you have performance in the top quartile year in, year out? And can you establish that that's going to be the way you're going to run your company and manage your company? My favorite interview once was asking the CEO of a not-for-profit how he wanted to pay his people. This was about a $15 million budget, which is not small, but not huge either for a not-for-profit. And he said, I want to pay my people just like McKinsey pays their consultants. I said, David, are you aware that McKinsey in a good year pays a lot of their consultants over $1 million? I said, how are you going to justify that in a not-for-profit for your top 10 people? And he backed off. But you see my point that you got to be careful with articulating where you want to go and how you want to be compared. Because if you say, it's one thing to say, I want to be at the median level for base and bonus and maybe higher for total compensation with superior performance. It's another thing to say, I want to be in the 90th percentile. And that's going to be where I'm going to strive from this point forward. That sort of causes the listener to think, well, you also have to have performance in the 90th percentile, which is very difficult to maintain, as we all know. I call that rarefied air. That's hard to be at that level. So anyway, starting with a good comp philosophy and matching the job well. We talked about what percentage of time does the incumbent perform duties in the different jobs. Doing a pie chart is a good thing. And then benchmarking. The bottom line is market pricing is part art, part science. It involves a lot of different factors, as I've tried to illustrate today. It involves reviewing jobs carefully at the beginning. It involves, if you have a chance, interviewing the executive to say where they are and what their track record is, what their history is, what their job responsibilities are, what the board demands of the CEO, for example. So you might want to interview both the comp committee chair and the CEO. You might want to interview perhaps all the comp committee members about the CEO's performance and what's expected of him or her. And then in preparing the report, it needs to be thorough. It should not be war and peace, but it should summarize the areas that you've looked into, what your rigor has been, what your discipline has been. Most judges appreciate that, and most judges understand a well-written report for what it is. And today, that's even more important. There's a lot of bluster and a lot of, I've seen sort of a less civility in the past couple of years. I think that's almost akin to the political area, but staying the course and being firmly grounded and using the right rigor is the way I'm always going to try to approach this area. And in litigation support, not every report is the same. Not every report will require a rebuttal report of the opposing witness. TASA does a lot of good programs on what your report should contain. But today, what I wanted to do is just highlight this area as an area that's important. It's an arrow in the quiver of most attorneys, knowing people that do compensation work, because you never know in what case and in what circumstance. I often work with valuation people, a valuation expert and a comp expert, because the comp often determines for a smaller company what the valuation is going to be, whether the comp is reasonable. So that's another area that's important to consider and be aware of. And I probably have worked with maybe 10 different valuation firms in the last 10 years. There are a lot of good ones out there. but it's important to be aware of where your expertise fits within the team. With that, Rochelle, I'm going to stop because it's right on the hour, and see if we have any other questions from all the talent that's hopefully still on the line, or if you're not on the line, I hope you got a little bit that was of interest.
Thanks, Bob. If I can have all the attendees enter the passcode for today. Also, if you have any questions, you can send those over as well. Question, what is the most common overlooked area you've noticed from the attorneys you've worked with?
Well, I think I've been fortunate to work with maybe 20 of the 50 states, different attorneys, and I don't think there's any. All the ones I've been lucky enough to work with are quick learners, and if they hadn't done a comp matter before they picked this up, I've been an expert witness in a couple nuanced benefit areas that are really, really technical. And one thing I've found that is that opposing counsel sometimes don't do their homework enough in the technical benefits areas. We represented a hospital in a merger situation, and opposing counsel was not tried to sort of question some of the things that we were talking about, and it didn't go well for his side. But long story short, this is, like most areas, this is an area that doing your homework will really put you on solid ground. It doesn't necessarily mean you'll win the case for your side, but you've got to be on solid ground to prepare one of these reports, because they're very technical in nature. They're very detailed. They show a lot of experience, and the judge is looking to you for your best thoughts.
And our last question, what critical mistakes are made by the expert witnesses in lawsuits of this nature?
There are three that I can think of. One is sort of taking shots at the opposing person writing the report. It should always be almost a B2B, a business-to-business approach. Secondly, not following what we just talked about in the previous question, the rigor that they should do. Thirdly, report doesn't often make sense. My best example is the one we just ended, where the peer group they used was 6 peers, when I could show that there were several dozen that could have been used. With 6 peers, for example, let's say that 5 of those peers pay $200,000 for the executive, and the 6th peer pays $1 million. So your average is going to be, if my math is right, 6 into 2 million, or 333,000, as opposed to 200,000, which is what the 5 peers paid. So you're going to be skewed if you use a small number of peers in that example. That just doesn't make sense. So I would always say the common sense rule applies. Sometimes I see common sense not used in opposing experts. Not very often, but just occasionally. So I hope that answers that.
Thanks so much for answering the questions, Bob. In addition to being your best source for testifying and consulting experts for the past 60 years, TASA also offers e-discovery of forensic solutions, free interactive webinars, day-in-the-life videos, research reports on expert witnesses such as the Challenge History Report 2.0, the Preliminary Screening Report, and the Expert Profile 360. Please remember that if you are applying for CLE credit, you must attend for the full 60 minutes of this presentation. You are also required to complete the survey at the end of the program. I want to take this opportunity to thank everyone for attending, and most especially Mr. Jones for his time and effort in creating this presentation. If you would like to speak with Bob, or if you would like to speak with a TASA representative regarding an expert witness for a case study you are working on, please contact TASA at 1-800-523-2319. One of my colleagues will be following up with you today regarding your feedback on today's presentation. Thank you all for attending. This concludes our presentation for today.
Thank you, Rochelle.